Hey there, my name is Karen Jones, content creator for the Society of Technical Analysts. Today we're looking at the US 10-year yield, and as you can see, it has, for most part of this year, looks like it's just gone sideways in a fairly big range, and it doesn't really look that interesting. However, I think it is quite interesting, and I'm going to show you why. Just going to point out here this purple line, which is the 200-day moving average, which is at 418 currently. Now, it's when we look at the weekly chart that things start to look more interesting, because I can identify on this a potential fall in wedge pattern. Now, for those of you who don't know what that means, they are generally seen as a bullish pattern once a break above the top of the range is seen, which in this case is around 453. So this is looking more interesting. This pattern is going to remain valid while we're above this support line. The recent low was at 360, and this support line dips down towards 350 towards the end of this year. So essentially, while we're above 350, this pattern is going to remain valid. We do have the 55-week moving average coming in at 424. And I think a break above there is going to trigger a test of the top of this range, as I say, is at 453. And should a close above there be seen, that is going to complete this pattern. And it would suggest that it will go up and test the old high that we saw at the end of last year at 502. And in longer term suggests that it is in fact going a lot higher. So currently we've got markets now pricing in an 87% chance of a 25 basis point cut in November. And they're betting on the fact that they think that the Fed won't deliver large rate cuts this year. So I actually think this is looking quite interesting from a longer term standpoint. From what looks like a sideways range, is potentially building a very large bullish pattern here, and one that needs to be watched. Thank you.